Click the bell icon to get latest videos from Ekeeda.
So in the first topic, we will be studying the difference between traditional investments and alternative investments. So let's talk about traditional investments first. Now, traditional investments include stocks, bonds, and cash. Those three are traditional investments, but the other investments like private equity funds, hedge funds, real estate, commodity, infrastructure, and many more. These investments are known as alternative investments. So, the first point of distinction is the investment option which you have. So in traditional investments, you can see long only publicly traded investments like stocks, bonds, and cash. For alternative, there are hedge funds, private equity funds, real estate, commodities, infrastructures, ETFs, exchange traded funds, etc. The second point of distinction is whether it involves use of derivatives, leverage, or short sale. You must be aware of derivatives. Leverage means that you borrow something and then you invest, and short sale means that you sell first and then you buy it back. So, traditional investments do not involve these kind of options, but alternative investments will involve these kind of options. Next point and distinction is liquidity of assets. So, as you know, stock, bonds, and even cash, these are all liquid assets. So, for example, equity and bonds, it can be converted into money very quickly. But real estate, on the other hand, cannot be converted into cash so easily. So, alternative investments are less liquid that way. Managers specialization. Now, for equity, bonds, and cash, manager specialization would not be that much. But for hedge funds, private equity funds, infrastructure, the manager needs to be specialized. So it will be more for alternative investments. Regulation and transparency. Now, what do you mean by regulation and transparency? So, as you know, in India, there is something known as SEBI. So, SEBI is the regulator of the capital markets in India. So, that includes regulations, and transparency includes whether the companies in which you invest are showing you the right picture of all the financials. So regulation and transparency will be high for traditional investments. You have all the data regarding stocks, bonds. So for traditional, it has to be high. But for alternative investments, you never know what is the price of one unit of a private equity fund, or you hardly know any real estate prices. These are all negotiated. So transparency and regulation is somewhat less. Next point in distinction is whether historical data and volatility of returns is available or not. So as you know, stocks are traded daily. You have all the data regarding their returns, their volatility, their beta, etc. So for traditional investments, it would be easily available, but not for alternative investments. As I spoke, real estate prices, you never know, it changes on a day-to-day basis. If I sold a flat for 1 crore, someone else must have sold the same flat for 1 crore 10 lakhs. So it is never decided, it is always negotiated upon. So only limited data is available for alternative investments. Now, the next point of distinction will be the fees. Now, if you want to buy any traditional investment like a stock, you need to pay a brokerage of minimum 2.2 or 0.3% of the cost. But for alternative investments, you have to pay the brokerage as well as two special kind of fees known as management fees and incentive fees, especially for hedge funds and private equity funds. Now, management fees means that if you have invested 100 crores, 2% of it would be deducted straight away. That will be the manager's fee. And incentive fee means that if you get a profit of say 10 crore, a 10 or a 20% incentive fee would be levied on it. That will go to the hedge fund. Now, the next distinction would be type of management. Now, if you compare alternative and traditional, traditional investments are somewhat passively managed, but alternative investments need to be actively managed. Just like hedge funds, they use long short strategies, so it has to be actively managed. But real estate and commodities would be somehow passively managed. Now, the next point is a restriction on redemption. Restriction on redemption means that if you have invested something in a stock or a bond or any hedge fund, there is some restriction to sell it. Now, for traditional investments, it would be really low. But for private equity or hedge fund or any such alternative investments, it can be high. Type of investment. So usually it is a direct investment in stock or bonds. So traditional would be direct, but alternative there would be some intermediary, just like your hedge fund or a private equity fund. So you invest money in that fund and then that fund will invest it ahead. So there is an intermediary in front of it. So the next point of distinction is type of investment. Now, in traditional investments, stock and bonds, there is a direct investment. You can directly buy the stock or a bond. But for alternative investments, there are specific intermediaries, which we can call them as special vehicles. So these special vehicles are the hedge funds or the private equity funds, or just like mutual funds. These intermediaries will invest your money ahead. Thank you for watching. Stay tuned to Ekeeda and subscribe to Ekeeda. Thank you.